Good day, my viewers, once again from everywhere you're watching me in Accounts and Business with Abiola. I'm here again, and nice being with you. The last class was on depreciation. We were only able to explain what depreciation is, the causes of depreciation, and methods of depreciation. And in that class, we were told that we will be doing the preparation of depreciation schedule and the disposal of assets. So today we'll be starting with how to prepare straight line method of depreciation. As was explained in the last class, straight line method of depreciation uses the same value of depreciation over the number of years of the assets. So if an asset is to last for, let's say, 3 or 4 years, that means depreciation for year 1, year 2, year 3, and year 4, as the case may be, will be the same amount. This is supported with the view that some assets like computers, they will serve us almost the same way, almost with the same efficiency for all the years. Hence, when we're depreciating, should show the same value. There could be some drawbacks to this method, but it is easy to calculate and it is easy to put in the financial statement. When cost is given and scrap value is given and the number of years is given, examiner or sometimes generally the business may have a rate that it charges its assets, 10%, 5%, 20%, 25%, or as the rate of depreciation. Hence, that percentage will be multiplied by the cost. However, if there is no fixed percentage prepared or being used by the business, the formula to use for straight line method is cost minus scrap value all over expected number of years. So illustration 1, let's use this illustration. The machinery was purchased for $10,000. It is expected to last for five years, and at the end of the 5th year, the scrap value is expected to be $1,000. The depreciation schedule will be $10,000 minus the scrap value, $1,000, all over number of years, 5. This will give us 9,000 all over 5, which is $1,800. That means if you are preparing depreciation schedule, our provision for depreciation account will be prepared this way. Year 1, provision for depreciation is an expenditure in income statement. Hence, it will be the value for each year will be charged to income statement as an expenditure. So income $1,800. So that is it for year 1. That's what we are charging. Then year 1 here will balance it. And for year 2, because it is depreciation using straight line method, the year 2 will be the same amount, which is 1,800. And if this balance carried down and we have this amount, then in year 2, that balance is brought down, and since the method of straight line will use the same amount, that means year 2's provision for depreciation will also be 1,800. That will be charged to income statement. So year 2 here, balance carried down will be 3,600, as this is the total that we have here. At the beginning of year 3, this balance is brought down again. That is the accumulated depreciation at the end of year 2 on the asset machinery, for instance. And the amount to be shown as depreciation for year 3 is still going to be the same amount, 1,800 income statement. So total here will be 5,400. So at the end of year 3, the accumulated depreciation is 5,400. Then we balance it here, 5,400. Then the beginning of year 4 will have the balance accumulated depreciation as 5,400. The same amount again of 1,800 will be shown as depreciation for the 4th year, which is shown in income statement as expense, 1,800. That means at the end of year 4, 7,200 is the accumulated depreciation, which is balance carried down, 7,200. And at the beginning of year 5, this balance of 7,200 is balance brought down. And since it's straight line method, the depreciation for that same year alone is going to also be 1,800 charged to income statement. So at the end of the period, $9,000 will be the accumulated depreciation shown here, $9,000. So year 5 will be balance carried down, $9,000. If we take it back to this formula, 10,000 minus 1,000 is 9,000. That is your total depreciation for the 5 years that the asset is expected to use. So hence, this will be our depreciation, provision for depreciation account using straight line method. So if you are preparing the extract of income statement for the 5 years, so it will be shown in the expenses side as provision for depreciation, for year 1 it is 1,800. Provision for depreciation for year 2 is the same amount. Provision for depreciation, if account is prepared for year 3, it will be 1,800. Provision for depreciation for income statement of year 4 will be 1,800. The same thing for the 5th year. This is an extra, which means that each year income statement is prepared. Provision for depreciation of the asset in that year will be shown as an expense, which is prepared here as an extract. So that is the income statement. Then the other account that we may show the extract of is extract of statement of financial position. Position as at a date. So we have the assets section of the statement of financial position. We have the non-current assets section. In this case, we have the machinery or plant and machinery. So the asset section has plant and machinery. So we have cost, aggregate depreciation, and net book value. NBV. The cost of the assets from this question is $10,000 for year 1. $10,000. The depreciation for year 1 aggregate is 1,800. So we have the value of 8,200 as our net book value. That means at the end of first year, the value of the asset had reduced to 8,200. For year 2, statement of financial position, assets section, we have plant and machinery. The cost remains the same, following the historical cost concept of accounting. That is explained in one of the classes. Please listen to it or watch the video on accounting concept and convention, also being released in this channel. Watch it, search for it, and you'll find it. Historical cost concept is what is followed here. So cost will remain the same even in the second year. So accumulated depreciation in year 2 is 3,600. So leaving us with the value of 6,400. In year 3, plant and machinery is still 10,000 at cost. Then depreciation, accumulated depreciation in year 3 is, at the end of year 3 is 5,400. So leaving us with the balance of 4,600. In year 4, statement of financial position, asset section will have plant and machinery, 10,000 as cost again. And then the accumulated depreciation for that year, at the end of that year rather, is 7,200, leaving us with the balance of 3,800. Then at the end of 2,800. And at the end of year 5, the statement of financial position, asset section, we have machinery, 10,000 as cost. Then accumulated depreciation is at the end of year 5, 9,000, leaving us with the balance of 1,000. If we look at this balance, it's the same as the scrap value given in the original question. This is the extract of financial position, that is the extract of income statement, and this is provision for depreciation account. If we need to open that asset account to the machinery account, it is an asset, so it has a debit entry because asset comes in and it is received. We can watch the video on Accounting 101 or Accounting Made Easy. This explains the concept of debit and credit entries. So machinery was brought in and at 10,000. If it was paid by cash or by bank, this goes to cash account. So that would be what we have to open using straight line method of depreciation for machinery account. For the next method, do I say thank you?
Thank you.
Okay.
So this becomes one video.
Okay. So that will be what we prepare for depreciation schedule using straight line method of depreciation. Thank you.